What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today I'll share with you another way that I cut down on my tax bill, something called tax loss harvesting. Now, as you may or may not know, in my day job, I'm a commodity trader. I trade futures and options on diesel and over-the-counter options and swaps on both diesel and propane, and even weather. One of the sort of perverse aspects of my job, though, is that adverse and positive events, but anyway, events that are out there, of course, are impactful to the market and therefore change the profitability of our position. This is something that I thought was touched on really well in the movie The Big Short, when the two guys from Brownfield Capital, Charlie and the other guy, are talking to Ben, and they're really excited while they're in Vegas about the fact that their position is generating a huge unrealized gain for them. So they really, sort of made a lot of money here, and they start jumping up and down all excited, and Ben gives them a tongue lashing, basically reminding that what they're celebrating is actually a really, really bad event for the American people, right? And how, an uptick in the unemployment rate is associated with a number of casualties of despair, right? So you've got higher incidences of alcoholism, depression, suicide, all that kind of stuff is correlated. And so I have these kinds of experiences at work sometimes, and also with my own stock holdings as well. One of these events recently was the Russia-Ukraine conflict. Look, I'm not an expert on these matters in geopolitics or anything like that, but what I will say is I find these events to be very, very sad. Now, while oil prices have skyrocketed as of this filming due to this conflict, in fact, over the past couple of days, as of this filming on March the 2nd, we saw some really, really sharp gains, things that I haven't seen in quite some time. We have WTI crude at over $112 a barrel at a high. The diesel contract that I trade has gone from being around $2.50, $2.75 to it closed just under $3.50 a gallon today. So it's a very volatile market, which makes sense. Russia is one of the 3 largest oil producers in the world. It's also a major supplier of gas to Europe. And then, this has, unfortunately, the potential to escalate even further beyond the confines of the current conflict. So, yeah, not a great situation. But anyway, oil prices have skyrocketed. And usually often you can see oil prices and equities to move in the same direction because, of course, economic growth is associated with global oil demand growth as well, right? So the economy grows, it needs more inputs, and some of those inputs are oil related. But instead, we've seen a real divergence where, again, oil prices are skyrocketing, but all of the fears around the conflict and a flight to safety have pushed stock prices down and then the dollar up relative to other assets, again, the dollar being a more safe haven currency. And certainly as the dollar-ruble trade has pushed it in that direction, with the ruble falling to record lows. Now, with this large decline in stock market values, then for those of us that have an after-tax brokerage account, then this actually presents an opportunity. So again, terrible things going on. That aside, right, there is an opportunity that we can take advantage of. So again, it is sort of a perverse thing about my job, and just, I don't know. Yeah. So this won't work, of course, if you're talking about a tax sheltered account. So it won't work within an IRA. It won't work within a 401k or the federal or teacher versions of those kinds of accounts, because it needs to have tax consequences when you realize any gains or losses. And so that's why we're talking about an after-tax brokerage account. So what we can do is we can sell lots that have as yet unrealized capital losses, either short-term or long-term. And then we can, of course, report those on our taxes for the calendar year, and thereby reduce our taxable income and get some tax savings. Now, of course, we don't just sell those assets and then not have a position in the market. What we want to do is to sell the assets and then buy similar but not identical assets in order to maintain our position in the market. So it's really an exchange, but this exchange does, of course, book these capital losses that we can then deduct from our taxable income. Now, why can't we just sell and buy back the same asset? Well, that would fall foul of the IRS wash sale rule. So they're savvy to that, and they don't want you doing that. So can't do that, but we can buy something that's substantially similar. These are things that are called tax loss harvesting partners. As you might know, my personal portfolio is really quite simple. Until recently, until late last year, all I owned was VTSAX, which is the Vanguard Total US Stock Market Index, and also VTIAX, which is the Vanguard Total International Stock Market Index. So just these two funds comprise most of it. Since then, late last year, like I said, I decided in order to improve my risk-adjusted returns, and just because we'd seen some really good times in the market, I decided it was time to add a small percentage of bonds, and so I added a small allocation of Vanguard's Total International Bond Fund and Vanguard's Total US Bond Fund as well. So now I have 4 funds in my portfolio, but still relatively simple, and the vast majority of it is still VTSAX and VTIAX. So let's take VTSAX for instance. What would be a good tax loss harvesting partner for that? Well, if you think about it, the Vanguard Total US Stock Market Index holds over 1,000 of the larger companies here in the United States. It's meant to be fairly representative of the broader market, but it is market cap weighted. That means the bigger the company is, the bigger its market cap is, then the more of it we're going to own. And so something like the S&P 500 index would be not a bad tax loss harvesting partner, because again, those largest 500 companies would represent really the core holdings of VTSAX, the large majority of it. We do miss out on some of those smaller companies, so it's not a trade-off I'd like to make forever, but it is something that we can do in the short term. And when I say that we don't have to hold on to it forever, the other rule the IRS has, besides the straight up don't buy the same asset back, is that you can't buy that asset back within 30 days, right? So we have to wait at least 30 days, which for me is going to be March the 27th. Before then I could potentially switch back from the S&P 500 index to the Vanguard Total Stock Market Index. Now, when we do that, of course, we'll need to look at what the unrealized gains and losses on our new position is as well, to make sure that it's not going to undo any of the work that we did, and still make sense for us. But I imagine that around that time, I'll still have been able to book some decent losses. We'll see, it's worth a shot. And if not, then there weren't any transactions costs, and so it's not a really big deal. I'll just get back to my original position. So that being said, this is going to work best, right? When the market falls, and then you exchange funds, and then either the market stays the same within the next 30 days for you to flip back, or better yet, when the market falls even further. And that's something that happened to me back in 2020. Of course, COVID, the pandemic, again, not a happy event, lots of human suffering, really awful, but there were losses in the stock market that I was able to take advantage of, and I sold off a lot of shares, and I was able to book a capital loss of $4,694. Now, you can't book the entire loss within one tax year. I think the limit is $3,000. So I was able to book $3,000 and reduce my taxable income for 2021. For 2020. And then the remaining $1,600 I was able to carry over and book that for my 2021 taxes. So that was nice to see. When last month in February, I went and did my taxes for 2021. That capital loss carryover was enough actually to move me from having a small tax bill of about $180 into having a refund of $190. So altogether worked out quite well. And then again, more recently, we have this the Russian invasion of Ukraine. So I've done the same. I've sold off a bunch of VTSAX and exchanged it for the S&P 500 index fund. And then for the international stuff, for VTIAX, I used a fund called VFWAX, which is the FTSE All World excluding the US fund. So pretty similar. And again, within 30 days, I'll take a look and see where the positions are, and see if it's going to make sense at that time to switch back, which ideally will be what I'll be able to do. And Vanguard makes it really quite easy to see what are the unrealized capital gains and losses on your positions. In the brokerage account section, you just click on cost basis, and then you can sort all of your lots by their unrealized gain/loss. And then you can just identify the ones that you want to get rid of. So on that point, before doing anything, of course, it would be very important to make sure that your accounting method when you buy and sell is done using specific lot identification. We do not, for this, want to be using FIFO or LIFO or average cost or any other system. Specific lot identification does take time for that to kick into effect, would be the way so that we can identify exactly which lots are the ones that we want to exchange, right? All right, so let's say that I booked a loss of $2,000 this year. Then what happens? Again, when I go to file my taxes next year for this year, then I get to reduce my taxable income by those $2,000. If let's say that I'm at the marginal tax rate of 15%, then I would be able to reduce my tax bill by 15% of the $2,000, which would be $300. Now, of course, there is no free lunch, right? Because what we're effectively doing here is reducing our cost basis, right? We bought these funds, they lost, and then we bought something else that's similar at that value, and then that's going to appreciate over time, and so we'll have to pay on those gains at some point anyway. However, given the time value of money, I would much rather have that money now to invest in the market and have that grow versus having that that little bit of a tax bill sometime in the future. Who knows when I'm going to be realizing those gains. So I do think it is very much worthwhile. If you found this video worthwhile, do please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.